Welcome to this risk management and retirement planning webinar. We have David Cook, our senior financial advisor here at Pure Financial Advisors. Welcome. How are you doing today?
I'm doing good. How you doing, Catherine?
I'm doing
Happy to
great.
be here.
I know we have a lot to talk about, so I'll let you just get started.
Hopefully, we'll be going over a lot of ideas to help you understand and navigate the different risk factors that we all face. And it's not about risk avoidance, it's about risk management. And my goal is to hopefully go through these factors simply and equip you with some practical insights on how to best manage some of these risk factors that we'll all be facing. So with that, let's jump right in. So let's go to basically understanding really what risk management factors we're going to be discussing. So we're going to be talking about, of course, longevity risk, and I'll be going into specifics a little bit more in each of these. We'll be talking about inflation risk, the sequence of return risk. Of course, there's interest rate risk, liquidity risk, we've got market risk, we've got tax, we got opportunity risk, and those are the main areas that we'll be discussing and how to understand these risks in our own world. And simply how to understand what's the best way to address them and control these risks as best as we can. Again, this is about management. This isn't about risk avoidance. So kind of moving forward, again, why risk management is so important. Well, again, you think about, and we manage risk every single day, whether we're driving in our cars, we're jumping on a bike, riding down the boardwalk, dealing with, traffic. There's a lot of different risks that we're managing. And it's really about understanding how to manage the risks that we can control. So it's really getting prepared for the unexpected, because we know it's going to happen. And secondly, it's making sure that you protect not yourself, but you're also your family, and also your own personal picture, how to make sure that you can manage these things without having perfect visibility in everything that's going to happen. And again, in this day and world, there's so much noise out there. And so it's really trying to break it down to what can you control, because there's a lot of things that are out of our control. With the news cycle happening so fast, we're getting our news in this kind of headline kind of feed, and we get so caught up on these things. And it's kind of like, I'll use some analogies. I love aviation, so I tend to use a lot of aviation analogies. If a pilot is flying at 30,000 feet, he's not worried about what the weather is at 5,000 feet, right? So it's just understanding the types of things that we can control and trying to making sure that you maximize the control of those. And then everything that's out of your control, well, that's just going to be something that, again, is not in our control. So moving forward, I'm going to start going into some of the factors that we're going to be facing. So kind of starting off with longevity risk, right? When we're younger, we hope to live a long, healthy life. And that's our goals as we age and go through our accumulation years. Now, as we get older, there's a risk of, what if I live a long, healthy life? And then that becomes a really tough complication in managing retirement assets and making sure, do you have enough? And making sure you don't outlive your money. So longevity risk is something that we have to kind of understand. And a lot of times when we do planning, we push it out as far as we can. Age 95, even though maybe the average life expectancy might be 76, 77, I want to make sure that if you do live a long, healthy life beyond your personal life expectancy, that is not, you're going to have coverage there. And there was an interesting paper that I read that did a study on the psychological impact of longevity. And it basically said those that said, I'm not going to live past 75, you have maybe your own personal genetics, maybe your parents didn't live very long. And the more that you verbalize that, the more you're going to actually speak it into existence. So I would say my recommendation there is don't play yourself short. Expect to live a long, healthy life, but also prepare for it. The next we're going to talk about is inflation. Now, inflation has really kind of taken a front row seat in the last several years. And really inflation is something that you need to evaluate in your own personal financial situation. When you're doing a cash flow projection, you got to put a really reasonable amount of inflation so you know that you're keeping up with inflation. Because it's not just when you look at your stock portfolio, okay, you might have a 6 or 7% rate of return. That's your nominal return. What if inflation was 5 or 6% that year? Your real return is maybe 1%. So it's about purchasing power. It's about understanding that inflation is an absolute part of the risk factors that we have to address and evaluate in your financial picture and your financial plan. You got to look at it over the next 5 years, also the next 10, go out to 20 years, and you see that rate of inflation can take a pretty big bite. So you got to make sure that when you're looking at your investments, that you're not too fearful, going out of equities because you're worried about a market, and then all of a sudden inflation hits and your cash might not lose anything, but if inflation's 6 or 7 or 8%, well, you've lost 7 or 8% of your purchasing power. So it's really making sure that you don't get too panicked. Now, we just went through the largest amount of inflation we've seen in 40 or 50 years. So of course, it's something that we have to address every day. And we've seen this ramp up of inflation, and it's not going to be easy to bring back down. But it's something that we need to understand. Now, inflation is going to impact people in different ways. If I'm a young family, like I have a niece that she's in her mid-20s, just had her first baby, got married. She had to move out of California to go live in Tennessee because inflation was going to be really tough on them and young families. So young families that are just getting started, maybe you don't have a house, maybe you have an old car that you're eventually going to have to replace in the next couple of years. Inflation is going to likely hurt those young families more than if you're retired. If it's just, you have two individuals going into retirement, maybe your house is paid down, you bought it when prices were much lower. And so inflation is going to impact you a little less. And then especially when you get into Medicare, inflation is going to keep somewhat under control because you're not going to see these big expenses. Now, if you're out doing a lot of traveling in retirement, you plan to spend a lot of money going on doing some more discretionary expenses, inflation is going to impact you more than if somebody said, hey, I did all my traveling in my earlier years, and I'm just going to kind of relax and kind of just hang out with the grandkids. So each person is going to have a very different understanding and impact of inflation, but it's something that you need to know and how it's going to impact your personal cash flow. So it's very important to know what your cash flow is and what your expenses are. Now we're going to move on to sequence of return risk. A sequence of return risk is essentially the danger of the timing of the withdrawals that you take in the early part of your retirement. The gist there is that if you run into a really bad market, like a market downturn in your early first 2-3 years of you taking withdrawals in retirement, that has a danger of really reducing the longevity of your assets. You can run out of money a lot faster. You lose 10% one year. If you just do 10% the next year, you're not going to be even, especially if you're taking a 4 or 5% distribution rate. So the sequence of return risk is something that you got to be mindful of. Now, to give you a perfect example of something that we just recently faced within the last few years, it's COVID. 2020, I had several clients that retired in January and February of 2020. If you remember, March of 2020, the stock market went down anywhere between 25 and 50%, depending on which asset class. Small caps, mid caps, all went down. Everything went down, and it did it very fast within 3 weeks. I had clients that were very nervous, especially if they pulled the trigger on retirement in February, to only see the market the bottom just fall out, right? So the idea of sequence of return risk says, let's say the next 5 years, you had a genie that said, the next 5 years, I know what the returns are going to be, 10%, 3%, 5%, negative 20, and 2. But I don't know which years those happen. So if you have a portfolio A that has all the same returns every single year that we've talked about, and you have portfolio B, and they just mix up those returns so the bad year happens earlier, those two returns are going to have the same average rate of return. But the portfolio that took the hit in the early part of the first year is going to have a shortened lifespan, shorter than the portfolio that maybe that bad year happens 3, 4, 5 years into retirement. So there's ways to address that. Again, you don't want to be caught going into retirement and have 90% stocks, say, for instance, right? Let's say you go into retirement and you have 90 or 95% stock portfolio and you're just about to start your distribution. Let's say you're going to take a 4% distribution rate and you've got $1 million and you're going to take $40,000 and all of a sudden COVID happens. Well, you're stuck pulling money out of an asset that's down 30% and you're taking volatility and creating a real loss. That's going to be very hard to dig back out. So that's why asset allocation is so vital, So you have safe money, you got a cash reserve, you got some bonds that maybe if you look at what happened in COVID, bonds actually started performing well after about 1 or 2 weeks into the drop. So then you don't take any money from your stocks, you let your stocks kind of heal and you take your distributions from your safe money. That's why it's important to have 20, 30, 40, 50% in bonds, even though it's going to add maybe it's a little bit of drag to the portfolio. It's very important to make sure you have a pool of money that you can use, not touch any stocks when they're down. That's one way to mitigate sequence of return risk. Now, each person is a bit different. Each portfolio is a bit different. So each one you're going to have to evaluate, but that's something that you have to keep in mind. Now, interest rate risk. Of course, interest rate risk is another risks that we've kind of seen recently. Again, a lot of these risks we may have talked about them theoretically 10 years ago. Inflation, interest rate risk, but those were pretty mild. Inflation had been pretty mild. Interest rates have been pretty low and hadn't really spiked or come crashing down. So we knew them that things like this happen, but now we've got real world experience. Interest rates had stayed low for many, many years. If you remember back to the recession in 2008, 2009, they dropped interest rates down to zero, Federal Reserve did, and they were only supposed to keep them there for maybe 1 or 2 years. Well, 2010, they kept interest rates at zero. 2011, interest rates zero. 2012, interest rates zero. So for the last 12, I'd say 15 years, the Federal Reserve kept interest rates very, very low. And what that kind of did is it ended up placing a lot more risk on those that wanted to have a safe portfolio, having bonds, because you didn't get paid much in your bond portfolio. Interest rates were low, and it also incentivized extra borrowing, and it kind of sparked more speculation on the equity side. So what we started to see is some retirees adding risk to the portfolio when it wasn't necessary, or at a time that they couldn't afford more risk. And so then we had interest rates really low. Then they started raising them in 2017, 2018, and then they kind of stopped, right? So you have to understand your own portfolio, how it's going to interact with interest rates. If you got a heavy bond portfolio and interest rates are low and they start going up, well, we'll talk about this later in this webinar, interest rates going up is going to push the current value of bonds down. And so you have to know what your asset allocation mix is, how it's going to interact with interest rates, kind of have a good situational awareness. Again, a lot of this risk management is, I'll talk about another aviation analogy. If you're a pilot, you got to really have good situational awareness. When you get into retirement, it's really important to have good situational awareness. What's the kind of the rate of inflation currently? You don't have to be an economist, but you got to have a kind of idea of what the current interest rate market is. Are you getting a favorable rate of return on cash? How much exposure do you have if interest rates spike, they come down? Again, only controlling what we can, because we can't control the direction of interest rates. We can control how that impacts our portfolio. So it's an important thing because we've seen it. We saw interest rates spike, and now they're kind of starting to fall, but the Federal Reserve had just kind of halted their short-term rates in January. They'll probably do a couple of rate drops this year, but that doesn't necessarily impact mortgage rates or the long-term borrowing rates for the government, for treasuries. So there's a lot of intricacies that it's important to kind of understand, again, in your situation, finding out what we can control. Now we're going to kind of move into another set of factors here. So liquidity risk. If we look at liquidity risk, that's kind of like where if you have assets that you are forced to sell, and maybe there's additional cost to sell, or you're selling at a downside, and maybe it's hard to sell. So you want to make sure you have enough liquidity to get you when you're in retirement. If you're taking a distribution, you're taking cash flow, you want to be as liquid as possible. But sometimes liquidity comes with a cost too. If you're too liquid, well, sometimes you're not going to get the types of returns you did if you had some things that are, like let's say real estate, for instance. Real estate is generally not a very liquid investment. If you take all of your bonds, you're like, I don't like the way my bond portfolio is acting. I'm getting 1 or 2% on bonds. I'm just going to sell all my bonds and buy a commercial property. You buy a commercial property, you're getting some income from it, but if something happens, there's an emergency, and you need to get access to that liquidity, and you're only getting the cash flow, well, then now you've got liquidity risk, because those bonds not only give you income, but they allow you to sell them in a time where there's distress in the equity markets, and you can use it for cash flow. If you have it tied up in real estate or even say gold or some of these more illiquid assets, you can be stuck. You can kind of be caught in a liquidity trap. So it's a right mix. Again, some things aren't liquid and they're actually going to perform good, but some things you want to make sure you got a good balance. Again, a lot of this is just a good balance. Market risk is obviously something that's most investors talk about, think about as you know, as a CFP and as financial advisor, is something that we look at a lot. But again, there's ways to manage the market risk, and again, that's through some of the things we'll talk about, asset allocation. And it's making sure that, again, that you're not too fearful. You take some of the noise out. Sometimes the markets are going to give us real-time information. Like right now is a kind of a perfect example of we're getting a lot of news, a lot of things happening, a lot of noise. But what's the signal? Is there any real signal coming into our, into our information that we're actually able to make good decisions? So sometimes watching the market will give us a little bit of a better indication of how the market is reacting to current events. Now, the market's never going to be perfect. But you think about the market, there's millions of participants that are evaluating real-time data. What's the interest rates? What's inflation? What's unemployment? What's going on in Europe? What's going on with tariffs conversations, right? So instead of getting all worked up and fearful in this news cycle, sometimes they just look at what the market's telling us, because it's not going to be perfect, but sometimes it's going to give us the best indication. Is the market really panicking? Is it kind of confident? Is it apprehensive? So sometimes watching your portfolio and understanding markets is going to kind of give you a little bit of insight. Same thing with the markets, could be the bond market too. You have capital markets, could be equities. Also, a big part of the capital markets is the bond market. Now, the bond market's going to act differently. Watching where yields are going. Are they rising right now? Are they falling? That will give us a little bit of an indication. Is there stress in the overall debt markets? Is inflation a cause for concern from the bond market? You will see that in the daily fluctuations of, let's say, the treasury yields. So you want to make sure you understand how to address your portfolio, what's going on, but also not oversteering. You really don't want to oversteer when it comes to market risk. Because like anybody, if you're driving down the road on a freeway, somebody starts inching into your lane a little bit, the last thing you want to do is swerve, because you can make a situation that was just, okay, maybe I just slow down a little bit or speed up, versus you could turn that into a really catastrophic event. So you don't want to panic. You want to stay away from fear, but you also want to stay away from the greed, especially as you're going into retirement. So market risk is something we'll get into specifically with asset allocation, how to manage market risk, but it's also understanding where it's at and what it's telling you. Opportunity risk is, again, kind of overlaps a little bit of that as well. Let's say you were really concerned about some event that's happening in the world or the markets, and you go to cash and you're like, this is really scary. I'm just going to get out of the market right now. Well, if you're sitting in cash and all of a sudden those events have been overplayed and the market says, oh, this isn't a big deal, I'm going to be fine. Perfect example is COVID. If you got out in bottom of March and you took a loss of 30 to 40%, there's no way that you would have been able to foreseen that the US stock market would have fully recovered by August. Because by August, we were still in the dark. We had still no idea what was going on in the markets. But now, unfortunately, what you did is you had an opportunity cost risk of sitting in the sidelines. You took the loss, the markets recovered, and now you're at a loss trying to catch up. And it's never going to feel comfortable to get back in. So opportunity risk is something that you got to make sure that you got liquid cash available. Let's say you're in a portfolio that's, say, 50-50 and the stock market drops. Well, maybe you've got an opportunity to take some excess bonds and buy when the market's cheap. Again, it's just making sure that you're not panicking and causing a bigger problem. Tax risk. We'll get into tax diversification. Taxes are a big piece of life. It's one of those things they say that, death and taxes are the certainties in life. Volatility is probably another one. But you want to make sure that you understand, have good situational awareness, again, of your tax situation. What's your marginal bracket? What is your taxes going to look like when you get to required minimum distribution age? Is that going to push you into a higher bracket? Understanding what your AGI is, how that is different from your taxable income, because some things are determined by AGI. Let's say your Medicare premiums. Some things are determined by taxable income, what bracket that you're in. What are your capital gains rates going to be? That's going to be dependent on what your tax bracket is. So again, understanding that taxes, 20 to 30 to 40% every year are going to take more from us than the likely the market will. So you really can't have a good understanding of market risk without understanding how the impact of taxes are going to be in your situation. We'll kind of get into that here in a little bit later. Now, risk management strategies, we're going to talk a little bit about asset allocation. Asset allocation there's a separate slide here. We'll go into specifics. There's dollar cost averaging. Dollar cost averaging is when you're building up an accumulated portfolio while you're working, you can reduce the timing risk by simply having a systematic contribution. And again, it's not just contribution into 401k. Maybe it's a systematic contribution into an individual or trust brokerage account that you don't get the current tax break today, but it accumulates in another pool of money. We'll talk about tax diversification, why it's good to have many different types of pools of money. But if say the market drops and you're putting in your 5, 10, 15% in the 401k, that dollar cost averaging, you're buying more shares when the markets are cheap. If the market's really expensive, you're putting your 5, 10, 15%, you're staying a static contribution, you're buying less shares when the market's expensive. So dollar cost averaging is it's a simple thing that you can do to kind of remove some of the timing risk. Rebalancing is also really important. You want to make sure that you're rebalancing and you're looking at your portfolio on a regular basis. That you don't, if the markets are doing really, really bad, a lot of times our instinct is to just not look at it. Just put it away. I'm not going to look at it right now because it's going to hurt. Sometimes that's the time you want to look at it. Now, you don't want to, again, go in and overreact to it, but maybe there's an opportunity, just like COVID, as I mentioned in March. Things were very, very cheap. You could have bought just about every asset class on a fire sale between 20 and 50%. And you could have had assets that were selling at a premium. You could be selling high, buying low. Now, you want to let the market tell you when to rebalance. There's a lot of big mutual funds or say the target date funds that were rebalanced based on a calendar system, like maybe once a year. Maybe at the end of the year, they do a big rebalance, or maybe it's if they're lucky, they'll do it once a quarter, but that's generally going to be more costly. So those are calendar date rebalancing. Don't necessarily recommend that because you might run into, let's say you rebalance once a year on July 31st. Well, let's say at that point of time, it's just before a market shoots up or drops and you rebalanced and you're not going to look at it again for another 6 months or another year. Well, the opportunity that you're losing by not rebalancing you could shrink the time it takes to recover if you do some smart rebalancing when the market's telling you, hey, we've got some things moving, time to rebalance now. That will actually shrink the amount of time that it takes for your portfolio to fully recover. So rebalancing is an important thing to do. There's some science involved in there, so there's some things that you got to make sure. Now, diversification kind of lines up with asset allocation. Diversification, as I say, is really the only free lunch we have in investing. And the idea and the art of diversification, the science of diversification, just means you have different asset classes that don't move up with each other. They call correlation is low. So let's say bonds and stocks have a low correlation. So when you put those together, what happens is you drop the overall risk of the portfolio. And the more asset classes that you can bring into your portfolio in an asset allocation model that don't correlate with each other, the more you get on diversification. Again, is the only free lunch that we have. And sometimes that's the only thing we got in terms of protecting us from market risk is diversification. Hedging, adding investments that kind of give you a little bit of a boundary, a cushion for, let's say, inflation hedge. It's important to kind of add some inflationary hedge positions in your portfolio. Sometimes there's currency hedging that you can do. That's a little bit more sophisticated. There's not a lot of, hedging that probably retail investors do. Sometimes the portfolio itself, by good allocation, diversification, you're building your own hedging within that. The tax diversification, we'll get into that specifically on its own slide. So kind of asset allocation. So again, asset allocation is kind of the science of building a portfolio, strategically dividing your portfolio into different asset classes. Now, the asset classes, you start off with a big, broad understanding. Let's say, again, if I look at just the most simplest allocation is stocks and bonds, right? You got fixed income and you got equities. Equities could be real estate, equities could be gold, stocks, and then you got your fixed income like cash and bonds, right? Every investor, whether you're Warren Buffett, whether you're managing CalPERS pension or you're managing your own IRA, that's usually the first question that every investor has to address is, what is my asset allocation? If you put together a good asset allocation, really what you're going to do is you're going to address a lot of the risks that we've talked about. A good asset allocation model will address market risk. It will address inflation risk. It will address longevity risk. It will address interest rate risk. And a good asset allocation should address even the sequence of return risk. So understanding how much you should have in bonds, how much you should have in stocks will all come back to what is your personal cash flow need in retirement. If you know you need to say take $20,000, $30,000, $40,000 out of your portfolio, you want to back that into 4 to 5 to 6 years of income in case something really happens. I can pull money out of bonds, sidestep sequence return risk, let my stocks come down and recover because stocks have always recovered as long as you invested into a diversified portfolio of stocks. Individual stocks can go down and stay down forever. You diversify, let's say through exchange traded funds, mutual funds. We've never had those asset classes drop and not recover. 100% of the time they've come back. So understanding your personal asset allocation is going to be important. Again, each person should have a different understanding of your cash flow need in retirement, but also your asset allocation is going to change over time. If you're young and you're accumulating portfolios, like your 401ks and you're adding, then you don't necessarily need to have a lot of safe money because you're not going to be taking any money out. So you're going to be probably able to absorb a little bit more volatility, a little more market risk. But asset allocation is really important to understand because this is going to, again, as I mentioned, address a lot of risks that you have in your portfolio. Diversification is really just a subset of that. Diversification is the byproduct of a good asset allocation model. Asset allocation model isn't like saying, okay, I'm going to have 4 different types of S&P 500 funds. That doesn't give you any diversification. Or say, okay, I'm going to spread it out between Vanguard, Fidelity, TD Ameritrade, Schwab. That's really not diversification either. Again, diversification, you have to really understand what the asset classes and how they're moving in lockstep with each other, because that's really going to give you the better understanding of truly how much risk aversion you have in the portfolio and how you're going to address the different types of market risks that you have. And it talks about stocks, bonds, cash. There is also what is called liquid alternatives or alternative investments. Those can kind of be like private equity, private credit, maybe some venture capital types of things. There is reinsurance, there's Bitcoin, there's gold. So you want to make sure that you're looking at all asset classes and that you're not married to one or the other. I see some right now, some really wide extremes, like saying I'm just going to only, going all the gold or all the Bitcoin and really not understanding where you're really undermining your market risk and you're adding no diversification. So having a little bit of everything, the right mix, is really going to manage a lot of the risks that you'll be facing when you go into retirement. Now, tax diversification. This is something that I think gets missed a lot. Tax diversification is something that we feel is vital because you can't have a good retirement plan that doesn't have a good tax strategy that's integrated. As I mentioned, taxes could take anywhere between 20 and 30, sometimes more, out of your portfolio every year. And it's something that you need to be able to understand. Now, when you look at tax diversification, and under this guideline, there's 3 different pools that you can save into for retirement. Though you got your tax-free pool, you got your tax deferred, and you got your taxable. Tax-free pool would be like Roth IRAs, Roth 401ks. There's Roth 403b options, and consider those to be kind of like the money goes in, you've already paid the tax. When the money comes out, you're paying no tax when it comes out, as long as you're taking those distributions as a qualified distribution, not an early distribution. The second pool, we have tax deferred accounts. Those are the types of accounts like in your 401k where you get a tax deduction for putting the money in. You get a deduction today, but again, that's just a deferral. The money grows deferred, and you take the money out, and you got to pay the tax on all the money that comes out at your highest level tax rate, which is ordinary income. Taxable would be anything that's outside of a labeled retirement account. Let's say you're lucky enough to inherit $100,000 from a grandparent. $100,000 is likely going to line up here on an inheritance. Now you can invest in all 3 pools. You can invest in the same investments. You can invest in Apple stock here, Apple stock there, Apple stock there. Cash, cash, cash. So it's not, these accounts aren't, you're not talking about investment type, you're more about account type. So when you're looking at all of these, of course, the best tax rate that we have comes from the tax-free pool. That's zero. No federal, no state tax, right? Everything here is what we mostly accumulate assets in. That's your 401ks, and that's where, well, a lot of times we'll see a lot of our clients that come in as pre-retirees, they might have the majority of their money here. And when they have all the money there, you got to remember that at certain ages, you have required minimum distributions that you have to take out. And the government's going to say, that's great. You've accumulated a good amount of money. Now it's time to start pulling the money out, and you get taxed at whatever the future tax brackets are going to be. And so then the taxable account here, you're going to be paying likely what is called capital gains rates. Now, capital gains rates are generally going to be lower than they are for your IRA distributions. Generally, right now, about 15%. If you're in the 12% tax bracket, capital gains and qualified dividends are actually taxed at zero. Another very important aspect of knowing situational awareness. So what you want to do is kind of have an idea of, you want to have money in all three pools. So as you're saving, you want to be mindful, do you have access to these three pools of money? And so when you pull money out, it's a way to control your taxes in retirement. If you want to create a tax efficient income stream, like a personal pension of assets that you spent 20, 30, 40 years accumulating, if you've got these three pools of money working, you can blend the income. Let's say you need $40,000 just to say you have a little bit of Social Security, and you need about $40,000 out of your portfolio. You might take 20,000 out of here, let's say 10 here and 10 there. So you're only going to be paying ordinary income tax on the 20 here. The 10 that you bring out of the Roth, you're paying no tax, and maybe you're paying a portion of that 10. Maybe you're only $2,000 to $3,000 in capital gains, but that rate's going to be lower. So it's a making sure that you manage your tax distributions, and you can kind of control your taxes. A lot of people think when they get into retirement that there's no way that they can control their taxes. That it's just kind of a foregone thing that I'm in retirement, I'm just at where I'm at. That's not true either. There are ways to get money out of the tax deferred pool into the Roth pool through what is called Roth conversions. So let's say here you haven't accumulated anything in the Roth, and you're past working age, so you can no longer do Roth IRA contributions. Well, let's say you've retired and you've fallen into a lower tax bracket. It might make sense to start converting, paying the tax, and putting money into your tax-free pool and letting that money grow tax-free for the next 5 to 10 years, because there's no way out of this tax. You've deferred it. It's like paying. So if you think about the money that you put in, you're deferring money on the seed. So if you're a farmer, let's say this account is $500,000 and your own contributions over the years was $150,000, right? So you got $150,000 that you've deferred on income, but your account is worth, say, $300,000, $400,000. Well, you've deferred tax on $150,000, which is the seed. Now you got to pay tax on the full harvest, whatever the full value is, whether that's $400,000 to $500,000. So what you've done is you've paid tax. I mean, you've deferred tax on the seed, and now you got to pay tax on the harvest. The opposite is for the Roth. You pay tax on the seed. As it grows, there is no tax on the harvest, right? So now, as you're in a high tax bracket, you want to manage that. Again, it's not an all or nothing type of scenario. You want to make sure that if you have the ability, as you're younger, you're in a lower tax bracket, you want to maximize your Roth IRAs and even your Roth 401ks. As you kind of get into your peak earning years, maybe you want to blend it, or maybe you want to get the tax break today, and then you're planning, once you first retire, start doing a 4 to 5 to 6 year conversion strategy, getting money out of here, paying the tax at a known rate, a comfortable rate that makes sense for your long-term tax projection. Just saying, okay, I'm just gonna rip the Band-Aid off, I'm gonna pay my taxes. Again, then there's no way around it. The thing is, you're controlling the taxes that you're paying on the conversion, right? As long as you understand your tax situation. And so that's going to allow you to have more tax diversification. So when it comes to, let's say you're in retirement and you want to buy a car and you really don't want to have a payment in retirement, right? Let's say you've got some cash set aside for a down payment, say $10,000 to $20,000. If all your money is in an IRA and you have a $60,000 car, if you take that all out of your IRA, that $60,000 car is going to cost you about $85,000, because you're going to have to take $20,000, $15,000, $20,000 to pay taxes on that distribution. If you have money here, you take $60,000 out to buy that car, no taxes, right? Because you paid your tax over time, and the growth is now caught up and you got that tax-free growth. Same thing here. So again, it's about having that diversification. It's really important that you don't just sock everything here, that you want to make sure that you've got a blend. And this is a way to make sure that you manage in retirement your tax bracket. As we're facing, really large amounts of debt in our society, we've seen all kinds of case studies saying there really is in the future, we're going to have to see taxes go up. And so the likelihood is we want to be able to control the taxes at the rates that we have today because we're at the lowest tax rates we've seen in our lifetime. And so again, that's tax diversification, something that's really important. Now I'm going to kind of move into, okay, the risk management process, as we're kind of saying, is again, it's really understanding, identifying the cause and the nature of the risk, really determining, what are you willing to retain in yourself as a risk? Are you able to self-insure? Do you want to supplement that with an insurance company, or you want to say, I don't want any of this risk. I want to pass this on to somebody else, basically understanding how much you're able to retain, and then determine how to handle the risk that you have retained. Now we get into the retirement risk zone. This is essentially, these risks that we talk about, you're really going to face them almost your entire life, whether it's inflation risk, market risk. But when you're talking specifically about retirement, the 5 years before are really critical. Again, as you're accumulating, as we talked about, where your tax diversification, understanding what inflation is likely going to be for you in retirement. What are your expenses? What are you spending today? Most people want to go into retirement with the same amount of living expenses, same lifestyle. So understanding what that is before you get to retirement is really, really important. So you might want to do a test drive on what you expect to spend in retirement. Do that for 3 to 6 months. So you have an understanding, is that going to be enough when I get to retirement? Do I have enough? You might need to really load up your retirement dollars and non-retirement dollars in those years to try to get as much as you can in so you can retire comfortably, not worry about longevity risk, right? So then, of course, the 5 years after is really important because that's where the sequence of return risk comes in. If you retire, it's February of 2020, and you're two months before a 30 to 40% market drop, what are you going to do? What's your plan? Does inflation happen? Do we go to 10 or 15% inflation 2 years into your retirement? All those sorts of things are really critical. Do we get a big tax increase right before retirement? Are you in a low tax bracket that you could have been doing conversions because you fall for a low tax bracket before Social Security hits, before RMDs hit, and you could have been converting those dollars at a low tax bracket? That's something that you want to make sure in those 5 years after that you're very hyper-focused on your tax diversification. So that's kind of the risk zone. Of course, the idea is you're accumulating assets and you spend them down over retirement and making sure that this isn't 75 or 80, that if you're expecting yourself to live to 85, 95 here, you don't run out of money, right? So it's understanding all those sorts of things. Now, this kind of starts getting into investment vehicle risk like bonds. I'm just going to talk just briefly on this. Bonds, again, there's a lot of different flavors of bonds. You've got corporate bonds, you've got government bonds, you got mortgage-backed securities. Short term would be like a 1-year bond, and you got intermediate 5 to 6 years, and you got long term, let's say 15 to 30 years, right? So you've got short term, long term. Traditionally, you've got more risk as you go long, less risk as you go short. But the longer you go, you should get a higher interest rate. And I say should because that can change. We just went through a period of almost 2 years where we had what's called an inverted yield curve, where short-term rates were actually paying you higher than long-term rates. That's a sign of distress. Again, as we're looking at markets, what are the markets telling us? When the yield curve is inverted, it's telling you it's stressed, that there is some recessionary pressures. So it's understanding what is the current market doing, but understanding where your risk is. So you don't want to generally take a lot of risk in bonds because you don't get benefit. There's not a big benefit by taking a lot of risk in bonds. When the interest rates were low and there was a risk of them going high, you wanted to kind of line up and stay in short-term bonds. Now, as interest rates are kind of high, kind of starting to fall, you might want to start extending the length of your bond portfolio to have more locked-in rates that are at a higher point. Let's say you're getting a 5.5% interest on your bond portfolio. If you lock that out from a 1 to maybe 5 years now if the interest rates fall, you're getting that interest rate for the entire time. You're not risking falling. You're seeing your interest rates fall as interest rates fall. And of course, there's a credit rating. Sometimes I'll see this, oh, this is paying a 9 or 10 or 11% interest on this bond. If it's paying 11% in a 4% world, that tells me that that company has a very low rating. They used to call those junk bonds. They call them junk bonds, and now they call them junk bonds today. Nobody would buy them. So they call them high yield now. It sounds better. But you got to understand that there's a much higher probability that those companies won't exist if their credit rating is too low. So you don't want to extend and grab too much risk in the bond market by going junk status. Now high yield bonds are a good asset class to probably bring in. Again, it's like a spice. You want to add it where it makes sense. You don't want to overload and have all your bonds in the junk bonds or high yield status. Maybe it's having some government bonds, some short-term bonds, intermediate, corporate, and then adding in a few percentage points of high yield bonds because, again, non-correlating assets are really important. And we just saw the interest rate risk really pronounced with bonds. In 2022 was one of the worst performance we've ever seen for government bonds. If you remember in 2022, in March, the Federal Reserve was starting to ratchet up interest rates. And they had, all of 2022, for about 16 months straight, they were pushing interest rates up to kind of try to combat inflation. So in 2021, when inflation was really high, interest rates were really low, you have big institutions like banks, insurance companies, and pensions were loading up on government treasuries. And those might have been paying 1.5%. All of a sudden, they raised rates very aggressively, and those safe bonds dropped anywhere between 20 and 30%. The worst performance we've really seen since the Revolutionary War in terms of government treasuries. So the answer to mitigate that was to go short-term bonds. Now, if you remember what happened in March of 2023, we had those banks fail, like Silicon Valley Bank, some of these other banks failed, because in 2021, 2022, early on, they were loading up on long-term government bonds. And because there was a lot of liquidity that was created during COVID, a lot of deposits coming in. When those deposits stopped, they needed to sell bonds to get their cash reserves up. And that meant they were taking massive losses on the sale of those bonds at the worst possible time. That's liquidity risk that they didn't manage very well. They didn't manage liquidity risk. They didn't manage interest rate risk. They didn't manage inflation risk. So there's a lot of things that they did wrong. And again, in your own personal situation, you got to, again, having good situational awareness of where those are, because every portfolio should have a certain amount of bonds in them because they provide safety. It's like having an airbag in your car. If the markets are going down, you can pull money from bonds and not have to worry about it. Now, not every time, bonds and stocks move in different directions. Sometimes they move in the same way like they did in 2022. It's rare, but it can happen. Generally, they don't have a high correlation. That is not always the case, though. Again, understanding your portfolio is really important. Stocks, we all know stocks. Equities, they tend to be a good inflation hedge. There's a lot of different styles of stocks. There's small companies, there's mid-sized companies, large, there's growth, there's value, there's international, there's emerging markets, there's domestic. So it's really understanding where those assets fit into your asset allocation, making sure that you don't ignore certain asset classes because they're all going to move at different speeds. So again, stocks are a good way to kind of make sure that you keep up with inflation. And they also are, going to give you your best chance of seeing some decent growth. But again, you got to be diversified. You got to understand the risks that you're taking. Now, kind of getting into risk obstacles, we talk about identifying risk. Do you have the right insurance? Do you have enough insurance? Planning for the future risks and caring for dependents. These are all the different obstacles that we have. Again, we're really not trying to avoid, we're trying to reduce, accept. Here we have health insurance. Obviously, you got your private insurance, you got Medicare, and then of course there's Medicaid, which is more of a federal funded. We'll get into specifics here, and you got life insurance. We'll talk about that here in a second. I'm just going to kind of move into those slides, get into specifics. Health insurance, of course, individual or group. If you retire before Medicare age, you got to make sure that you understand the types of medication that you need. You make sure that what that cost is going to be, and you include that into your financial plan, because you might be going from $300 to $400 a month on insurance through a group plan, and all of a sudden you're paying $1,000 before Medicare kicks in. Now, Medicare kicks in and it's going to reduce that cost. Now, group plan, of course, is understanding what your medical situation is. Do you want to have a certain group of doctors that you can always see? And so you kind of get into different types. Now, this is getting into Medicare. It's 4 parts of Medicare. You got Part A, which is that's your hospital insurance. That's the taxes that get taken out of your income. And it's about 1.45% that comes out of your paycheck each time you earn a dollar. Your employer is paying 1.45%, you're paying 1.45%. That's basically going to cover Part A. Now, if you're self-employed, you get to pay both of those. Now, Part B is going to be more of the medical insurance that is through Medicare. That's what you're paying currently. The Medicare premium on the base rate is about $184 right now. And you got Part D is prescription drugs, and that's going to be a separate add-on that's going to help. There's different plans for that. I'm not going to get too specific into Medicare. That's a whole nother webinar. Now, Part C is going to be your Medicare Advantage plans that it kind of wraps all of those together, and it's going to be mostly like a closed loop. And it's going to be, kind of be something that you're not going to have as much flexibility, but it's likely to be a lot lower cost. Now we kind of get into Medicare options. We kind of talk about, you got your original Medicare, Part A, Part B, and then you got your Medicare Advantage plans, which, it's kind of like an all-inclusive. It feels more like a group plan from your work. It's not a PPO style, it's more HMO. And then sometimes the Part D is included, but a lot of times your base premium, $184, might cover your Medicare Advantage plan. But again, you're somewhat limited. It's important to go in and make sure that you understand this before you turn 65, because that's when you it's only for those who are 65 and over, unless you're under disability. You got to have at least 10 years of paying into the system. You got 3 months plus your birth month, and then 3 months after to apply. If you miss the application, you're not getting covered. There's about a 10% penalty that stays with you forever. Now, it's also, you want to make sure that you know what your AGI is going back to taxes, because your AGI is going to determine what rate that you're paying in terms of premiums. There's a thing called IRMA that's going to determine where are you paying just the base rate. The next rate is a 40% increase, and it can go higher from there. It can go up to 320% of the base rate if you're AGI. So if you sell a house, have a large capital gain, you might have a really big, huge increase on your Medicare for that it's usually 2 years later from the taxes. So again, understanding and just knowing kind of where that's going to cost. Medicare does not do a very good job at long-term care. It does cover you for really it's 100% covered, first 20 days, 20 to 100 days, you get about 204 days. After 100 days, it ends. So it's not there for long-term care insurance. It's mostly there to give you short-term. Like if you have a stroke and you need to go into physical therapy and you're into a situation that's going to be 30 to 60, 90 days, well, Medicare will likely cover that. But beyond that, it won't. We'll talk about Medicaid. Again, this is mostly for situations where it's more of like a welfare program. There is some criteria you have to look at, and that's your income, assets, and look-back period. Currently, there's about a 5-year look-back period for federal. I think California's 2.5 years. So what they do, they look back at all your expenses or transfers. If you're transferring money, gifting to kids to kind of make sure that you get qualified for Medicare, they may go back and do a look-back period and say, well, those assets are going to be included when we actually look at how much aid you're going to get. So you have to be mindful of what those income requirements are. Now, there's a lot of changes happened in the last year. There's going to be like more changes. So again, that's a whole nother webinar. Again, we talked about Medicare versus Medicaid. Those are two different things. Medicare is mostly federal health insurance. Medicaid is more of an assistance program for low-income individuals. Now, long-term care insurance. This is a really tricky scenario. Back in 2002 was the peak of selling traditional long-term care insurance. I think about 750,000 policies were written. As of about a couple of years ago, only about 45 to 49,000 policies. So there's about a 93% drop in the number of long-term care insurance being underwritten. You're seeing a lot more of this kind of hybrid policies where you get a life insurance that it kind of can change into long-term care if you need. And they call these kind of a hybrid. So if you have a whole life insurance, old policy, you might be able to take cash value and exchange it into a new kind of hybrid policy that has a long-term care rider on it. Again, it's something it's a really tough, it's like a 100-sided Rubik's Cube to try to figure out the situation, because expenses are getting higher and people are living longer. And again, this is a whole nother topic, but it's not easy to manage this risk, but it's something to, again, understand. If you have your house paid off, you might be forced into a reverse mortgage, that sort of thing, to help you with those, the end of life expenses. So kind of going into life insurance, I'm just going to spend just a really short period of time here. You got term insurance, which provides protection over a certain period of time. You got permanent insurance, which is more like whole life, universal life. I tend to be more of a fan of the term insurance because life insurance is really there for income replacement. So if you're 10 years from retirement, you generally don't need to have life insurance that goes beyond that. So you might get a 10-year period of a term insurance at that point to make sure that you're covering the income that could be lost if in case you pass away and you leave your family without that 10 years of income. So you generally want to match the terms to when you think you're going to retire. So if it's 20 years, 30 years, 10 years, life term insurance is going to be the cheapest, most purest form of insurance. Permanent insurance is really there if you get a pension and you don't choose a survivor benefit for your spouse. You might replace it with some whole life insurance, universal life insurance in case something happens, that pension falls, but then your spouse will get some insurance. That's one way to manage that. Again, this is going to be part of the slides. You can go back and read it. I'm not going to get too into the weeds because I think we need to have some questions we want to go through. Staying healthy, of course, nutrition. You want to be able to, when you get into retirement, if you want to have an active lifestyle, health is very, very important. And it's one of those things that you want to stay active and you want to have a long, healthy, retirement life that is going to keep you moving and keep your mind active. It's not just your body; it could also be your mind. Again, making sure you don't get too overwhelmed with the news cycle because I know some people can get fearful what's going on. You want to make sure you control what you can. Stay healthy mentally and physically is important. And as you get older, you want to make sure that your house is safe for you. If you're getting a situation where you're not as mobile, you want to make sure there's people that can come in and kind of do evaluation of your home to make sure it's not a risk for you falling, different things that happen as you get older. So these, again, the risk management strategies, kind of know your situation. Again, situation awareness is critical. Carrying the right insurance, making sure you have cash reserves and emergency funds so you don't go into debt for things. Your investments are diversified. As I mentioned, you limit your debt, you stay healthy. And again, do your due diligence, kind of keep up with what's going on. Just in your situation, again, those things that you can control. Now we're going to kind of go into questions.
If you have a Pure advisor, I recommend that you reach out to them and ask the questions if we can't get to them, because that is your greatest resource. If you do not, then I offer you that free one-on-one consultation that you can then speak to someone personally about your own situation and not just this high level information that kind of pertains to everyone. But I'll just give you a couple of questions in this last few minutes.
Sure.
First of all, given with all the fires that we've seen recently in California, how do we manage that risk, like for the home? Just real quick.
Great question. Yeah, because I don't think we even addressed that. So obviously we saw the devastation that happened in Los Angeles and in other places around the country. So I think it's a good opportunity right now to really do an evaluation of your insurance, homeowners insurance, earthquake insurance. Get your declaration pages out of your insurance, know what your coverage is. The first thing I generally do is what is your replacement cost on your homeowners insurance? Pick up the phone, schedule a time to talk to your insurance company or your broker and find out, are you way underinsured? You don't want to be caught underinsured, especially with the fire risk that we have here in Southern California. So again, this is a good opportunity to make sure that you have the right level of insurance and you want to be cheap with homeowners insurance. With inflation, it's almost double the cost of building in the last 5 or 6 years. And if you're unlucky enough to be in Los Angeles where you've got 5, 6, 7, 10,000 people trying to rebuild, you can imagine the demand is going to be high, supply is going to be low. What does that happen with the market? That means prices are going to be even higher to rebuild. So it's a really good opportunity to find out the health of your company that's insuring you, making sure that you have a very healthy replacement cost. It's not too low, but review that with your insurance broker. Great question, Catherine.
Okay, there's a few questions that were very detailed, but one that you might be able to quickly answer. Does Roth conversion need to be done during your working years, or can it be done when you're retired?
So yeah, you technically can do a Roth conversion while you're working. Some 401ks will allow what they call an in-plan conversion. Let's say you're unlucky enough to be laid off and you move a 401k into your IRA. You're still in your working years, but let's say that year you have a dip in your tax bracket. That's a good opportunity to maybe pay to do the conversion then. So you can do it in your working years, but it's also important to know that you have opportunities to convert while you're also retired. The majority of the conversions we do are going to be just in that 5 year zone before and 5 years after. But you need to really understand your tax situation to understand when's the right time to do it, what tax rates you're going to pay. So each person could be different.
Okay. For sequence of return risk, back to the beginning, do you
Mhm.
recommend a bond tent leading into retirement, ramping up your percentage of bonds through retirement, then after X number of years, your ramp percentage of bonds back down?
I don't think you necessarily have to do a big tent. I think again you have to understand what is your distribution going to be when you get into retirement. So knowing mapping out your expenses, knowing what income you're going to have, and knowing what need is going to be. Like I said, if you need $40,000 a year, you want to make sure you've got 3 to 4 to 5, as maybe as long as 7 years of bonds to cover that. Now, we generally don't expect the market to take 7 years to recover, but that means that you're not trying to add a bunch of bonds right before retirement and then dropping them. You can just go in with a nice 5 to 6 years of bonds. Let's say again, if it's $40,000 you need, let's say that's $200,000. If you got a $700,000 portfolio, you put $300,000 in bonds, and there's your beginning of your asset allocation. I don't think you necessarily need to build it up too much. Just know what your distribution shortfall is going to be when you go into retirement. So then that will give you a much more customized level of how much bond you actually need going into retirement.
Okay, and this is also a bond question. It might be a little detailed, but maybe you can pick a couple things. So bonds are paying 4 to 6%, not good. FIAs ties up your money for years, pays the same 4 to 6%, even though they tell you different. But buffer ETFs will pay to a cap of 12 to 15%, but losses or 15% or more, depending on what you pick. Sounds great if you're loss averse, like most of us in 60s and 70s. I know that's a long question, but what can you kind of talk about bonds versus, when he's talking about the FIAs and ETFs?
Yeah, so there is some of those index annuities that they will tend to give you a 1 to 2 year kind of special cap that you can make more. My experience is that's an introductory cap, and once you go in for 2 years, they slam them down. If you actually read a contract, a lot of these fixed index annuities, they'll tell you in the small detail. Usually the salesperson selling you the bond that annuity is not going to tell you. Detail says they reserve the right to always change those caps. And I've seen it over and over and over again. It looks good when we get in, but then those caps slam down. Now you're to a 2 to 3% cap. So again, it's understanding what your target return should be. What's the interest rate market? What are you trying to get with your bonds? If you're trying to get a return, you're trying to get above interest rate return. That's what your stocks are for. That's where you're going to take a little more risk, and that's what your stocks are supposed to give you, that return above bonds and above inflation. A fixed index annuity, sometimes when interest rates were low, like we just went through this long period of low interest rates, that was probably a better time to consider fixed index annuities, where you might be able to get a 3 or 4% rate of return when bonds are giving you 0 to 1. Now, as we're moving into a higher interest rate environment, you have the opportunity to lock in a 4 to 5% rate of return without having to get into a contract. Remember, a fixed index annuity is a contract with an insurance company. Two things I tend to try to avoid as much as possible are contracts and dealing directly with a contract with an insurance company, because they're not benevolent actors. But sometimes they are an important tool. You can place them into a fixed income portfolio to try to give you a little bit more of an upside there. But again, there's a lot of different things. Each person's different. It depends on what your cash flow need is going to be, what your risk tolerance is as well.
Well, gosh, that we've got right exactly 1 o'clock. So, David, thank you so much. We were not able to get to all the questions. And as I said, please, if you're a pure client, please reach out to your advisor, and they will be happy to answer all of your questions. And if you're not, then we welcome you to come and join us and have a private conversation with a professional here at Pure Financial. Just get your questions answered. So we hope you're having a great day. We thank you so much for an hour of your time, and we hope to see you next month as well. David, thank you for all your time.
Thank you, Catherine. Good to be
Thank
here.
you. Take care.